You do advise hedge funds and hedge fund managers, and you have a wide sort of a view of things. So, and I guess it's in your interest to say that obviously investors are going to keep flocking to the industry, but you do believe this as well, right, Don? Tell us why. Give us some evidence.
Well, first of all, the assets in the hedge fund industry have gone up 9 years in a row. And I don't see any reason why they won't go up again next year. They've also went up every single quarter last year. And, you know, I think the big disconnect is a lot of people try to compare the performance of the hedge fund industry to the S&P 500, and that's simply not what investors are using to compare their hedge fund performance to. Most of these pension funds are taking money out of fixed income. Aggregate is currently yielding about 2.5% and are looking for a 4 to 6% return from hedge funds. Last year, average hedge fund was up 8 to 10. They're very happy, much higher than what they got in their fixed income portfolio.
Still, when it comes to the industry itself, though, it looks pretty saturated. You estimate that there are about 15,000 funds out there. So when we see some of them closing,
you know, the industry is like a duck. You know, on top of the water, it looks very smooth. Assets keep going up. But below, it is very Darwinistic. You know, you have to keep reinventing your process. If you don't keep doing that, your performance will go down. We saw some very high-profile managers close down. Strategies that worked 10 years ago doesn't mean they work now. For smaller managers, they're getting hammered. Fees are coming down. Expenses to run a hedge fund are going up. Only about 2% of assets are going to hedge funds with less than 100 million. That's where most of the hedge funds are. A lot of them aren't profitable. You're going to see more close down.
Well, now, macro managers had a very, very tough time this year, Longshort in particular. What do you see in terms of the more successful strategies for 2018 and maybe the less successful ones?
Well, I'm very bullish on Asia. You know, Catherine Burton had a great article about long-short equity managers focused on the U.S. underperforming. In Asia, it's the absolute opposite. IMF shows that 2/3 of world growth is going to come from Asia. Only 4% of hedge fund assets are there. Low PEs, high volatility, large ownership of retail investors. I think it's a place to make money long term. Hedge funds that bridge the gap between private equity and hedge funds. Direct lending, people that do finance leasing on aircraft. You can pick up significant yield advantage over marketable fixed income securities. Quant strategies, you know, information advantage doesn't last very long. These quant strategies trade very, very quickly, get in and out of the market. Right now, 7 of the top 11 hedge funds are quant oriented. More money's going to go in there.
Going back to Asia, just because I come from there just a few months ago, and when we're there, Bloomberg has this good hedge fund brief that it comes out every Thursday or Friday, right? And we have this focus on Asia in Hong Kong, and we're always talking about how there aren't enough products coming out of India, coming out of Vietnam. Asia is big. Where are you looking at?
Well, first of all, I think there's a lot of interest broad Asia, so everything from China all the way down to India. So there's some managers that focus on that, long-short equity. There's a lot of people very interested in China. You have some very large hedge funds over there that have generated very strong returns over a very long period of time, completely blown away the index. The past 2 previous years, for institutional investors, no interest in Asia. Today, a lot of them are talking about it. A lot of them are beginning to allocate.